Hello, my name is Otaviano Canuto, and I'm a senior fellow at the Policy Center for the New South. This is the fifth of a series of short videos dealing with subjects covered in my recent book, Climbing a High Ladder: Development in the Global Economy. After dealing with dimensions of trade globalization in our previous videos, today we shift to macro financial issues, and later we will approach financial globalization. Let's approach today the hypothesis of a secular stagnation, and also why David Levy, chairman of the Jeremy Levy Forecasting Center, has pointed to an evolution of advanced economies toward becoming big balance sheet economies. You may recall from my first video when I made a reference to a triple price shock happening in the 90s and 2000s in the global economy, reflecting a shift of tectonic plates. The first four videos dealt with the supply shock associated with lower labor prices and foreign trade. Now we move to the second one. Why has the price of capital in advanced economies declined? And which structural changes have come with it? When I say declining price of capital, I have in mind the decline in long-term real interest rates as depicted in this chart. Look at the steady decline of long-term real interest rates, the price of money. The price of money, like any price, is determined by the balance of supply and demand. So why has the price of money, measured by inflation adjusted, that is to say in real terms, 10-year or 30-year interest rates, fallen so steeply over the past few decades? In principle, the rate decline must have one of two explanations: too much supply of money from savers or money holders, or too little demand for money from investors, or, of course, some of each. And I will argue that is both. An excess of accumulation of financial wealth relative to the creation or addition of new assets. See how this relates to central banks. Central banks typically peg short-term interest rates and try to influence the whole yield structure of interest rates to manage aggregate demand and keep inflation on target. They and/or other dedicated institutions also deal with stability of financial markets and institutions. Interest rates, despite being a monetary phenomenon, they end up anchored in real terms by single or possibly multiple levels determined in the interaction between finance and the real side of the economy. Following David Levy, we try to illustrate here how the downward trend exhibited in the chart reflects an increase of financial wealth over and beyond the incorporation of new assets to the economy, with a corresponding rise of the size of private balance sheets relative to the real economy. So let's try to understand in which sense the US and other advanced economies would have evolved toward becoming big balance sheet economies. David Levy refers to the big balance sheet economy era in the United States, to the period since the mid-80s until nowadays, as a period in which private sector balance sheets became disproportionately large enough to have a powerful influence on consumer and business behavior and on the business cycle, significantly changing the behavior of the economy. And let's start by looking at the evolution of debt and of monetary policy interest rates, which is, look at this. Well, but first, notes how the low and declining long-term interest rates that we saw in the previous chart were accompanied by a private non-financial debt rise until at least the global financial crisis of 2008, 2009. Private non-financial debt corresponds to the debt of households and non-financial corporates, while government and financial corporates would be the other sectors, okay? But also note in the chart how the short-term interest rates established by the Federal Reserve Bank followed a trend of decline along its cycles of hike and descent, with decreasing peaks along those cycles. As I said, the central banks set their basic short-term interest rates following their inflation targets, and they moved the rates counter-cyclically relative to the ups and downs of economic cycles, as the up and down phases of the economic cycle come with corresponding inflationary or deflationary pressures. Now, one factor leading to lower interest rates was definitely a change in the inflation landscape toward low inflation rates since the 80s. There are several explanations for that. One of them, trade globalization, including a period with devalued exchange rates of China and other Asian exporters of manufacturers, provided favorable price shocks through imports to the US and other advanced economies. Another explanation, another hypothesis refers to the lower bargaining power of workers since the 80s, which has led to weaker pressure for higher wages during phases of low unemployment, flattening what economists call the Phillips curve. But also a third possible explanation pointed out is that success and credibility of central banks' inflation targeting regimes would also have stabilized the private agents' expectations about inflation and so on. But in addition to all those, as debt ratios grew rapidly in this era, as you see in the chart, they would also have helped the cyclical peaks of the federal funds rate to be progressively lower as financial stress emerged at lower interest rates in each cycle from the 90s onward. And the same applies to the cyclical troughs, as you can see in this chart here. That is to say, the rising debt ratio meant not only a falling ceiling for interest rates, the policy rates, but also a falling trend of cyclical interest rates in the bottom, as each successive recession and financial crisis required lower rates to enable the economy to regain financial stability. So we are talking about the cycles and interest rates. Let's say a bit about this relationship between finance and macroeconomic activity, which have a two-way relationship, of course. Assets and liabilities are stocks at the moment in time that reflect investors' expectations about future flows of returns, as well as the ability and willingness of money receivers to comply with obligations. All this seasoned with varying degrees of confidence on such expectations. Over time, in turn, the actual path taken by the macroeconomic activity feeds back on finance. So finance can lead the macroeconomic activity through leverage, that is to say, debt in relation to income, or acquisition of shares, with both cyclical and structural consequences. Let's look at the cycles. This chart that I took from the IMF's April 2021 Global Financial Stability Report, just released, depicts the connections between leverage, financial conditions, and macro financial stability, which are tightly intertwined. Financial conditions, they are usually measurable or observable by a series of indicators, and they reflect the price of risk in an economy. And it constitutes a key driver of leverage buildups. When financial conditions are loose, intermediaries and markets have a greater incentive to take on more risk and a greater capacity to lend. At the same time, borrowers, firms, and households have a greater incentive to take on debt and, through heightened net worth associated with higher asset values, a greater capacity to borrow. So leverage buildups may lead to a financial vulnerability as high levels of indebtedness turn households and firms to become more susceptible to adverse shocks. When these shocks arise and financial conditions tighten, financial stability risks may arise from any sudden correction of asset price and abrupt deleveraging by firms and households. The combination of risk repricing and high leverage may well spark nonlinearities, whereby tighter financial conditions interact with deleveraging, which in turn cause additional repricing of risk, and so on. So the higher the level of indebtedness before the shock, the greater the likelihood of such deleveraging becoming highly disruptive. That's why the IMF observes that leverage, while making possible a ramp up of real economic activity, can also act as an amplifier of adverse shocks. See, degrees of confidence are embodied and embedded in financial conditions. A great macroeconomist, Hyman Minsky, wrote about how leverage followed cycles of boom and bust. In periods of stability, as time passes without crisis, economic agents tend to feel more secure to raise leverage. And after a certain time, and when many of them follow that procedure, systemically, the underlying macro financial stability becomes fragile enough to succumb to any shock, after which the unwinding of leverage, happening possibly with non-linearities, leads to a crisis, often with fire sales of assets and illiquidity turning into insolvency. So financial conditions in the chart would well be the locus where to find Hyman Minsky's changes of moods about uncertainty and confidence. Macro financial policies, monetary macroprudential policies, and fiscal policies also influence leverage buildups, either through financial conditions and the availability of credit, or through the effects of policies on factors such as income, unemployment, inflation, and debt service costs. Macroprudential policies can help to lean against the wind, that is, tighten to lessen risks to future financial stability. And we will approach them in a future video. These policies can accomplish this objective by taming leverage buildups or by strengthening borrower and lender resilience. Okay, that's about the cycles. And indeed, look at this. In the last 30 years, we have seen three major asset-driven cycles, with advanced economies being lifted and then hit by large macroeconomic shocks arising from the financial side. Note in the chart the ascent of the net worth of US households vis-a-vis GDP, particularly during the booms. The US business cycles that ended in the last three recessions involved progressively greater and more troubling risk-taking behavior. Each ended with worse financial fallout and a longer period of recession and weak recovery. And also, a similar bubble-led growth process could be found inside the Eurozone, starting with the downward convergence of perceived risks and interest rates throughout the Eurozone after the introduction of the new common currency. Countries that later on ended up under stress, Greece, Portugal, Spain, Ireland, they were able to sustain domestic absorption much above domestic production capacities for a long period, easily financing the difference because of falling from having domestic asset value appreciation. The underestimation of fiscal risk can also be seen as a manifestation of the euphoria. But the point made is that asset price dynamics has now been mainstreamed as an important subject to be addressed by policymakers. Macroprudential policies are now a component in the macroeconomic stabilization toolkit. And as I said, we will dedicate a video to them. There is a chapter in the book fully dedicated to the topic. But now, there are also structural trends taking place along the cycles. It's not simply a matter of cycles unfolding. Look, the chart shows that the total value of US household assets rose relative to income throughout the economy along the cycles that we just saw. And accompanied by rising debt. The chart shows a broad measure of private sector indebtedness, the combined debt of the household sector and the non-financial business sector, in proportion to the size of the economy's income, the GDP. This ratio rose more than fourfold from 1945 to its peak in 2009. Some categories of debt have declined relative to income, but others have risen. The household sector debt to income ratio left behind its housing bubble excesses in the wake of the Great Recession and has continued to trend lower. We will see a bit later on how things have been now in the time of the coronavirus crisis. But the non-financial corporate sector's debt to gross value added ratio kept rising toward a new all-time high. And this becomes particularly clear when one takes out the largest 5% of listed corporations, because then the corporate leverage picture becomes even more extreme. One indication of the risk associated with this increased corporate leverage is the substantial rise in the proportion of companies with ratings just above junk levels in the past 12 years since the global financial crisis. So keep two headlines here. Private sector balance sheets grew faster than income over several decades. Aggregate debt grew faster than aggregate income, but also aggregate assets grew faster than aggregate income. And this disproportionate balance sheet expansion with increase of net worth changed the financial parameters in the economy, making financial activity compelled to take riskier behavior. Now, look at what happened as those balance sheets rose relative to income. There's a feedback loop. The secular swelling of private balance sheets to income ratios may be counted on as one of the responsible factors for the secular decline in interest rates, because it has forced lenders and fixed income securities buyers to accept lower yields or purchase riskier assets. The flip side of the secular increase in the assets to income ratio was a secular decline in operating rates of return. The chart shows how current income, that is to say the sum of corporate profits, non-corporate business income, rents, and interest, fell relative to assets. Part of the shrinkage of current income relative to assets was caused by falling interest rates, of course, but that was not the entire story. Rates of operating returns on non-interest bearing assets also declined, as the falling interest rates helps to increase valuations. The point is that you have a feedback loop in which rising balance sheets, the search for returns leads to a dispute even to existing assets. And this appreciates capital, but makes it harder to keep the returns as time goes by with the rise of net wealth vis-a-vis income. So investors not only faced falling interest rates on debt instruments and cash deposits, but also falling rates of operating returns on investments aside from interest earning assets, including net rental income on commercial property and profits on corporate equity. And investors responded by either A, investing larger shares of their portfolios in pursuit of capital appreciation, as opposed to operating returns or dividends, or B, investing in assets with highly variable performance by higher average expected operating returns. Either way meant taking more risks. And look at this. This chart place side by side the net fixed investment, which has been small in recent times, particularly after the global financial crisis, against asset price gains that have been considerable over the course of the expansion. We will deal very soon here with the puny investment ratio that you see in the chart. But the point is that the longer the economy and asset price kept growing, the more confident investors became, the more private balance sheets expanded, and the more fragile the economy's financial structure became. The swelling of the asset side of private balance sheets during the 2010s expansion has been notable. Asset prices across a wide range of categories have risen. The pressures of the big balance sheet economy have once again compelled investors to bid prices of whatever existing assets to substantial heights. And don't think this is something only relative to the US economy, because as you can see, other economies in the rest of the world also displayed record balance sheet ratios. Now, let's keep on the global and see a bit how things have happened more recently. The non-financial sector came into the COVID-19 pandemic crisis with historically high levels of leverage, again defined as the reliance on debt in relation to income. On the back of highly accommodative monetary policies pursued by major central banks that have eased financial conditions since the global financial crisis, non-financial sector debt worldwide increased from 138% to 152% of GDP over the decade leading up to the end of 2019 after the global financial crisis. As you can see in the chart, non-financial corporate sector debt increased in both advanced and emerging market economies, reaching as a historical high of 91% of GDP at the end of 2019, prior to the pandemic. Household debt also, they rose sharply among emerging market economies, but fell in advanced economies as a group. We already approached this, reaching something close to 60% worldwide, the household debt at the end of 2019. Government and non-financial corporates have occupied the space left by households. But obviously, the COVID-19 shock increased additionally non-financial sector leverage across economies, even if for different reasons. The crisis squeezed cash flows for the corporate sector, and through its impact on employment, increased the financing needs of households. The unprecedented and warranted monetary and fiscal policy support launched during the containment phase of the pandemic has eased market dysfunction, loosening financial conditions after a sharp tightening in the first quarter of last year. And the monetary and fiscal policy support maintained the flow of credit to households and firms. Still to be seen is the extent to which the overall transfer from the public sector to households will lead to higher private savings for some, while others have simply increased leverage. Obviously, we will dedicate a video in this sequence on the coronavirus pandemic rise. Now, we have highlighted so far the role of asset bubbles in the pulling up the growth trajectory of advanced economies. But what if some underlying secular trend of stagnation is underway, making the economic dynamics dependent on the balance sheet economy getting bigger and bigger? See, if the growth trend is dependent on the overspending induced by the financial frenzy coming from credit and house price bubbles, avoiding future asset price booms and busts might simply lead to stability around low growth rates. And such a view underlies the possibility of a secular stagnation trend mentioned by economists like Nobel Prize Paul Krugman and also Lawrence Summers. They and other, say, Keynesian economists have suggested an array of possible causes for the US economy and others to display a propensity for aggregate demand shortfalls, in the sense that as a result of structural conditions, aggregate spending would be enough to ensure full employment and use of potential output capacity only in the presence of negative real interest rates, or alternatively, very low interest rates for long periods and with central banks bloating of their balance sheets by asset acquisition. So this would be an investment drought, or as a flip side, a savings glut, as measured by levels of non-consumption expenditures required to sustain income at full employment. And such an investment drought, or savings glut, could be seen as underlying the fact that despite the extreme looseness of monetary policies since the global financial crisis, average economic growth rates have fallen short of the levels of previous decades. This has been the case in the US, where average growth has been lower, even if there was a long period without any recession until last year, until 2020. Now, several long-standing factors could be pointed out as dampening investment. Let me single out some of them here. First, rising income concentration. Rising shares of income accruing to capital and the very wealthy, as we approached in the video on global inequalities. That rising income concentration would lead to overall underconsumption, only occasionally countered by unsustainable over-indebtedness of the poor. Another possibility another explanation is associated to demographic changes. Decreased mortality and increased longevity would be changing the demographic structure in advanced economies, affecting both demand through increased savings and supply through reduced innovation activities. But also a third factor often pointed out are the features of technology evolution, which might be also contributing to an investment drought. See, steep declines in the cost of durable goods, especially those associated with information and communication technology and or outsourcing, would mean lower spending levels associated with investment plans financed from corporate savings. Furthermore, the trajectories of technological evolution currently unfolding would not carry an array of high return investment opportunities comparable to past ones. And indeed, let me approach again the evolution of net private domestic business investment that appeared in one of the previous charts. So this chart shows the net investment in equipment, software, building structures, and so on. Net meaning new investments minus the depreciation of old investments. For in the case here, net investment for private domestic business as a percentage of gross domestic product. To smooth the data from frequent variations, the author, Peter Coy, graphed it as a 10-year moving average. So the latest data point here is the average since late 2010. Look, Professor George Mason University, Tyler Cohen, approached stagnation as an outcome of the exhaustion of a significant set of low-hanging fruits reaped in history of mankind, namely one-off supply-side opportunities associated with post-war reconstruction, trade opening, diffusion of new technologies in power, transport and communications, educational attainment, and others. And indeed, look, the rise of intangible assets has made possible for economies to become more elastic in their ability to supply goods and service without triggering inflation. This is due to the rising importance of intangible investment as a share of total investment in economies across the world, in addition to greater global integration. Intangible investments, which include investments in certain types of technology, but also improvements in business processes, economic competencies, and branding, they are distinct from tangible investment typified by plants and equipment. They are more scalable, have more synergies, and have other defining features. So a higher degree of intangible investment embeds a greater degree of scalability in production. In turn, this implies that economic output can increase or decrease more in response to shocks or even policy measures without necessarily exhibiting the same degree of price changes as has been in evidence in the past, and also without creating demand for fixed capital. Look, think of the whole set of fixed capital and infrastructure investments associated with the second industrial revolution, starting at the end of the 19th century and fully developed in the last century. Nothing comparable in terms of physical, tangible investments can be found in the technological revolution in course, even if it also increased productivity. Okay? Now let's look in some detail the argument of income concentration as a base for the argument of chronic insufficiency of aggregate demand in advanced economies. Look at this. As we saw before, today's global economy has become debt dependent. This is the evolution of debt. There is the weighted average across 14 advanced economies. And this debt dependency, according to our previous argument, happened because of the mismatch between financial wealth searching for yield relative to investment opportunities. This has suppressed real interest rates and made demand far too reliant on debt. But it's also possible to point to inequality as one of the forces driving this rise in leverage and its consequence. Beyond the point, inequality weakens an economy through the underconsumption mechanism, and that drives policymakers into a difficult choice between high unemployment or ever-rising debt. This phenomenon of rising household debt and rising inequality is not unique to the US, as you see in the chart. It's widespread, judging by the weighted average displayed in the chart. Let's look at the US. In the case of the US, Rising inequality has resulted in a large increase in the savings of the top 1% of the income distribution, not matched by a rise in investment. Instead, the investment rate has been falling, despite declining real interest rates, as we already saw here. And the rising savings surplus of the rich has been accompanied by the rising the saving or consumption above income of the bottom 90% of the income distribution, with some stability after the global financial crisis. So look, the argument about inequality leading to secular stagnation because of lack of sufficient aggregate demand does not depend on savings gluts being created and then searching investment opportunities. It corresponds to a waste of not fully use the installed GDP capacity over time and using the available labor force, eventually bringing down investment rates, of course. There is a clear link between the saving of the rich and the saving of the less rich and the accumulation of credit and debt. Since 1982, the decline in net indebtedness of the rich has been matched by the rise of indebtedness of the bottom 19%. By the way, that's why the argument that low interest rates accompanying unconventional monetary policies, the QE, hurt the less well-off. It doesn't stand. The less well-off are not large net creditors. The rich are the ones holding claims on the less rich, not only directly via bank deposits, via equity holdings in business that also hold such claims. So lower interest rates are better from the standpoint of the less rich than otherwise. And it's in the U.S. where global demand and supply tends to balance, as well said by Martin Wolf, whose article is the base that I'm using here. In the case of the U.S., the savings of the rich might have led to a current account surplus, as it occurred in late 19th century United Kingdom. But the rich of the rest of the world have sought to accumulate U.S. assets, and so generated a persistent U.S. current account deficit. And except when the pre-financial crisis housing bubble drove up private investment, this has also remained too weak. The main destination of excess foreign and domestic savings have been less well-off households and the government. As I said, one of our next videos will be on global current account imbalance. So there are two apparent ways to go. The first is for governments to keep on borrowing and spending. But obviously, in the very long term, this is likely to lead to some sort of either default, loss of value, or other form of debt haircut. And the well-off, who are the principal creditors of government, are bound to bear much of the cost in one way or the other. The alternative is to shift the distribution of income in order to create more sustainable demand and so stronger investment without soaring household debt. So, in a nutshell, that's some takeaways. From the mid-80s on, the era of the big balance sheet economy, financial decision makers have had to choose between progressively lower returns and higher risk. An extreme value of aggregate assets relative to income means low yields and low operating returns on assets, and therefore an economy vulnerable to asset price deflation. Each successive business cycle in the big balance sheet economy era has started with proportionately larger balance sheets and has involved more reckless balance sheet expansion, leading to even bigger balance sheets and a worse financial crisis. Each successive crisis with more bloated balance sheets to stabilize was more difficult to resolve, and therefore it required the governments to engineer new lows in interest rates. involving unconventional monetary policies reaching beyond short-term public bonds and other measures to stabilize economic conditions. Those measures overcame recession and the chronic weaknesses of the economy, but in doing so, they necessarily caused further expansion of balance sheets relative to income. And increasingly unsound risk-taking has been occurred again in the 2000s. And that's why David Levy, from whom we took those, says that the US economy continues to face a bubble or nothing outlook. That's the title of his report. Participants in the economy and markets will keep increasing their financial risk until the expansion breaks down. And the bigger the balance sheets are relative to income, the more severe the breakdown is likely to be. Now, to conclude, several factors, including rising inequality, demographics, and technological features, may also be posing secular stagnation as a trend. So bigger government spending seems to be a likely way out, even for some time. You will find the discussion on hypotheses of secular stagnation and the discussion on macro-financial relationships in chapters 2, 4, and 18 of my book that you can find on those places on the slide. In the next video, we will approach the role played by central bank balance sheets in the recent evolution of this big balance sheet economy. Stay tuned.